Glad you're with us for another great edition of the Retirement Education Hour. Hi, everyone. Megan Mozak back in the studio today with financial instructors Kirk Cassidy and Dr. Paul Metler. Kirk and Paul, they're both with the Retirement Education Foundation, and this show is sponsored by that foundation. It is a charity. Its sole purpose is to help people like you and me retire successfully through education, really understanding what's at stake and what you need to know to have a successful retirement in the 21st century. It does not happen by chance or a hope and a prayer. You need that understanding. You need that education to know what you have to do to plan successfully here. And we're going to talk about a really important topic today that I know so many of us feel like we know about or should know about because, boy, it can really impact your retirement. We're going to go deep into actively managed mutual funds. And before we get to that topic and how it can impact your retirement, want to make sure that you are aware that this very program, you can also access it as a podcast. That means you can share it. You can listen to it again at your leisure. You can find it wherever you find your favorite podcast. Download it today. Just search for the name of the program, Retirement Education Hour. So I want to get into this topic of actively managed mutual funds. And Kirk and Paul, I'll start with this. So many people out there own them. They have them. But I don't think many of us actually know what they are or how they could put our retirement at risk. But I know the two of you are going to shed some light on that, correct?
We are. Paul, I love the title, The Bad, the Worst, and Ugly of Actively Managed Mutual Funds. I just love the play you put on that. And so, little warning to Paul, Megan, and our listeners. Anyone who regularly listens to our show know I get pretty passionate. I get a little hyper and excited. And I just had 2 shots of espresso right for this show. Intentionally, knowing this topic, I needed to get really ramped up so people would really hear us as we talk to you about actively managed mutual funds and how really, I dare to say useless for at least our listeners, those people within 10 years of retirement through retirement, those people with, call it $700,000 to $10-20 million, they're almost useless, Paul. I mean, they're an outdated dinosaur type of an investment instrument that I really, as we talk about this, you guys will all ask yourselves, why do we still own them? And one of the great things that we do in our class is we make a guarantee that after you're done with attending these 8-hour classes, we guarantee you will never own an actively managed mutual fund again. And be careful when I say guarantee. Here's the promise we make is if you still choose to own an actively managed mutual fund after our courses, we make a $2,000 donation to any charity you want. And we have taught over 10,000 people in these classes in university settings, and nobody has taken us up on that. Nobody has challenged that, Paul. They're so, it just plays on our industry's egos to pretend like they can do something really can't do, and they have no choice. It's their value proposition now. That's all they have.
No, it is, and I think it's important to clarify. Obviously, if you have a 401k, 403b, 457, you may not have a choice, right? So when you say, Kirk, you won't choose it. Let's be clear. Sometimes people don't have a choice, right? This is all they have available to them. But I think it's pretty clear that at the end of this show, people are going to appreciate that if you actually have a choice and you are, you've done well in in preparing for retirement, you're not going to want to own a mutual fund. There are so many better alternatives. And today we're going to dive into the bad, the worst, and the ugly. We're going to get into the 3 really bad aspects of mutual funds and why they're problematic.
That's perfect, Paul. I should really clarify when I say mutual funds. I want to make sure we're talking about actively managed mutual funds. So most people now in their 4s, as we call them, in your retirement accounts, you have index funds as an option. And we talk about that as a solid option, but not actively managed mutual funds. I'll tell you, if you're within 10 years of retirement, through retirement, register for one of they're like master's level courses or 8-hour courses. If you'd like to register, go to retirementplanningedu.org. That's retirementplanningedu.org.
The purpose of this is not to have a history lesson, but, if I can just say, When mutual funds came out, they were revolutionary. They, initially, I think the first mutual fund came out in the United States in 1924. And initially, it was great, especially for people who didn't have a lot of money. It was a way to access a professional manager, diversify their portfolio, and be able to access it if they want, have liquidity. It was great for somebody who was just starting or didn't really have access to the market in any other way. It made a lot of sense. That's a long time ago. We're talking 100 years ago. Actually, I just realized that. It's 100 years ago. Wow. Right? That was 100 years ago. Things have changed a bit over the last 100 years. And there's so many better alternatives that I think we're going to spend a little time talking about.
But yet, Paul, there are trillions and trillions of dollars, and we'll get into some of the numbers, but trillions and trillions of dollars still trading in actively managed mutual funds, of which, and we'll talk about this again later too, 40% of these actively managed mutual funds fail within 10 years. 40%. I mean, the statistics, the performance, the costs are going to amaze you guys. Honestly, if the regulators really cared, in my personal opinion, not the charity's opinion, so this is on me, so don't, right, on me. If the regulators wanted to protect the consumers, this is the first place they need to start. But it's such a massive piece of our financial industry, they have no choice. It's like, it is their value proposition. They pretend like they can stock pick and market time. And really, that shouldn't be our roles for you guys. I mean, investing isn't that hard in our industry. It's really not that hard to invest. It's really not. The market just goes up over time and just makes money over time. It is not that complicated. But to employ the millions of people and justify the trillions of dollars in fees, they've made up this industry called actively managed mutual funds. It's remarkable to me. So listen. All of you, we teach these 8-hour classes. They're almost master's level courses. These are advanced courses for those within 10 years of retirement through retirement. We'll call it $700 to $20 million. This is an advanced course, and they're taught at major universities and colleges in your areas, and we stream the class live if you can't be there in person. All we ask is for a $29 donation to charity to register. Go to retirementplanningedu.org. That's retirementplanningedu.org. Thanks for listening to the Retirement Education Hour. Be sure to follow or subscribe when listening on Spotify, Apple Podcasts, or wherever you listen to your podcasts. And now, back to the show.
Actively managed mutual funds. Now, typically I'd want to ask for the highlights, but in this case, Kirk and Paul, I think I just need to ask for the lowlights. What are those?
Well, I know you had mentioned when I said that in between segments, has something to do with hair and coloring, lowlights, but I think in today's topic, it's more about the challenges, the problems with mutual funds. So I know Paul's laid out 3, and we're going to get to the 3, and I'll list them really quickly. The bad being mutual fund taxes, the worst being mutual fund performance, and then the ugly is mutual fund fees. But I think it's really good, and it would be helpful for people to understand the scope of this problem and why. Because a lot of times people will ask us when they come to the class, why do people do this? Why do these things exist? How do they still exist? Generally around financial service related stuff. And I think it's helpful to remember that when you have, I think the number is now, Paul, I think you told me it was $22 trillion in mutual funds, actively managed mutual funds right now. $22 trillion. Think of the hundreds of trillions of dollars people are making, pretending like they can stock pick market time better than just owning an index. So they've created an environment that people have to believe the lie. They have to drink the Kool-Aid. So we're not suggesting people that are selling these things are all bad people. Heck, half of them don't even know the fee. They don't know half of the information around what they're actually selling. But there are a lot of them selling them because they can make a lot of money selling them. But setting that aside, I mean, think about it. Just watch CNBC, Bloomberg, Fox Business, watch any of them. And you're going to see all these different people managing money, managing funds with different opinions constantly, coming on with different philosophies and different systems and different ways to do research. And I mean, there's people using satellites to see how many people are coming in and out of, retail stores. I mean, they're looking at everything. But yet, Paul, they are so underperforming the index. They can't beat the stock market if you just bought the whole stock market itself. They 40% of them fail after 10 years. They're a mess, Paul. I mean, they I don't know how, but they keep coming on TV. And if they just get it right once, then they became the expert. They could be wrong 20 times, but if they get it right once while they're on TV, then they'll be brought back on. And now they'll raise money and people will invest with them because they got it right once. Not the 20 times they've been getting wrong. Not that over the last 30 years they're performing at about 4% and the S&P 500 is performing at over 10%. Not because they're triggering taxable events when there shouldn't be taxable events. I mean, everyone ignores that, and it's just crazy to me, Paul. I don't know how it still exists. I don't.
Yeah, it's.
Sorry, you can sense my frustration, right?
I think the numbers are staggering. And can I just throw one statistic that I think summarizes this whole show, right? Sure. One statistic, and that is, if you go over just the past 10 years, okay, and you take all the mutual funds out there, all of them, and the fund managers, 10%, only 10% got it right. Only 10% saw more than half of its picks do better than the index, meaning only 10% of mutual funds did better than the index. That means 90% picked more losers than winners. Now, I don't know about you, who would ever invest in a mutual fund that 90% of the time is going to do worse? And I think part of the problem is that most people listening, they're not. They may be picking mutual funds, or their advisors are picking mutual funds, but their advisors are telling them it's good, it's fine, and it may seem like they're doing okay, but they're not comparing it to the index, right? They're earning 2, 3, 4%. There's nothing wrong with that, but they're not comparing it to what they could have done, the opportunity cost if they'd have just invested in the index.
Paul, in the next segments, we're going to get into the taxes and then the fees and performance. And I think people will be blown away. But one of the takeaways is think about the type of person that usually comes into our business to manage money. We tend to be type A personalities that are very confident people. And, having the power or the impression that you have the power to be able to make these calls and win, and in an industry that is so difficult for people to measure good versus bad performance, it is so hard for people to quantify because, honestly, I don't know why they've made it so difficult. It's really simple. There's never been one mutual fund manager, not one manager in the history of mutual funds, 100 years, not one manager has ever been able to stay in the top quartile for 5 consecutive years. That means stay in the top 25 percentile of performance for 5 consecutive years. I've never seen an industry or something that performs so poorly, but yet there's $22 trillion of people putting money in it because there's a lot of money behind it. And there's a lot of conditioning and manipulation and marketing that puts into this that what once was a good tool is now an outdated, archaic tool that should go away. And so we talk about that in the class. So again, I think it's really important, guys. There's so much information that you guys are confused around when it comes to retirement planning, what's going to drive success. We're going to encourage you to register for one of the charity's 8-hour courses that are taught at major universities. If you'd like to register, go to retirementplanningedu.org. That's retirementplanningedu.org. Listening from outside Michigan or Missouri? We stream courses live from the universities so you can attend anywhere in the country. Go to retirementplanningedu.org. That's retirementplanningedu.org to sign up. And now back to the show.
Today, we've been talking about the bad, the worst, and the ugly as it relates to actively managed mutual funds and your retirement. I figured we should probably start with the bad. Let's get that out of the way. And that means taxes, right, Kirk and Paul?
It does. I think people get a little confused how taxes work with mutual funds. So I'm going to try to keep it. Anybody in our industry listening to our show, please understand I'm going to try to make this as simple as possible so everyone can understand conceptually what is happening with a mutual fund. So when you invest with a mutual fund, you actually own shares in the company, the fund itself. You don't own the underlying holdings that are held within that fund. Okay, so you have no control of when that manager who's managing the fund is going to buy and sell, let's say, Apple or Amazon or Netflix. You have no control over if and when something's bought and sold. You also have no control over when you purchase that fund, when you invest in that fund, what taxable liabilities are still sitting within that fund. In other words, they bought Apple many, many years ago at $50 a share. And today, if they sold it, let's say it was worth $150 a share. And the difference between the 50 and what it sells for today, even though you just bought this year into that mutual fund, you become responsible for that tax liability. And it doesn't matter if the market's up or down. If they sell it in that year, that is a taxable event triggering a capital gain event towards you. Now, full disclosure, I want to make sure everyone understands. When you hold actively managed mutual funds within an IRA or a tax-deferred account, then the tax impact, it's not an issue. It becomes an issue when you hold these accounts, when you own mutual funds, actively managed mutual funds, in what we call a taxable account or a non-tax deferred account. Then we have real issues, Paul. And I know I try to oversimplify that. I hope it was explained well enough for the listener to follow what is actually happening. They're buying and selling. And I think we'll talk about, when we talk about fees, turnover ratio, so you can measure how often someone is buying and selling within the mutual fund that could be causing taxable events. But I want to make sure they understand why them as the owner of the fund, mutual fund, have no control. If they own shares in that mutual fund, they have no control over when or if there's going to be a taxable event in any given year.
Yeah, I thought you did a great job. I think people get really confused because at the end of the year, people will see that they owe taxes on capital gains on a mutual fund that they didn't sell. And in fact, the mutual fund went down over the year. And they're like, how is it that I have a tax liability on a fund that I didn't sell and didn't do and went down? And it's because within that, as you said, within that fund, there are holdings. And when that fund manager sells a holding for a gain, they have to distribute that gain pro rata to everybody. And you're realizing a gain even though your individual mutual fund didn't go up. And if I could throw out a number, in 2022, this is staggering. In 2022, 2/3 of mutual funds make capital gain distributions, even though the S&P was down 18%. So think about that. The S&P was down. Most likely your mutual funds were down, but you pay capital gains because the fund managers had to distribute those gains to pay that tax. It's crazy, but it's all about pooling your money, and you don't have control over when things are bought and sold within that fund.
Paul, you recognize that is, I read something, so don't quote this as exact, but because you got to be careful on the sources. But I read something recently. Right now, if you're buying actively managed mutual funds, you're inheriting somewhere between 22 and 25% capital gains. That's what you should expect on an annual basis because it's already built up, right? The market has rallied. Right. And what happens? Here's the interesting part, Paul. What happens? Typically, we have a correction or a market event after a sustained rally. That is not uncommon. So when we have a sustained rally, when we have a rally in the holdings within the mutual funds have gone up, it doesn't matter when you purchase that fund. It matters when you own the fund. So if you own the fund today and you just bought it in 2022, or you just bought it in 2008, or you just bought it in 2016, or you just bought it COVID year, right? If you just bought it that year and the market is substantially down in the year, your mutual fund has really gone down in value throughout the year. With certainty, they're going to be selling and recognizing gains. They have to sometimes sell because there's so many people trying to get out of their mutual funds just to meet the redemption requirements, which we saw during the financial crisis, right? I mean, we saw that a lot with funds where people getting taxable events when the market was falling to the floor because people were demanding their dollars and they didn't have enough liquidity to give people their dollars without selling all the holdings. And many of those holdings were highly appreciated. Crazy outcomes. It's totally tax inefficient. That's bad. Wait until we get into worst and ugly. Wait, performance and fees. It'll really upset you. Look, what drives performance in retirement has nothing to do with what you're investing in. You need to come to a class so you understand what really drives performance for your retirement. If you'd like to register for one of our 8-hour classes, go to retirementplanningedu.org. That's retirementplanningedu.org.
Classes are forming now. Go to retirementplanningedu.org to register. Again, that's retirementplanningedu.org. Use the promo code PODCAST to receive 50% off your tuition. And now, back to the show.
Okay, we covered the bad when it comes to actively managed mutual funds. Let's move on to the worst. And when it comes to the worst, we're talking about performance. Is that right?
We are. We're going to talk about performance, then we'll get to the ugly, and that's the fees. But gosh, it's remarkable that an industry has been able to sustain 100 years and be this bad. And I want to be fair, Paul, because I know for many of our listeners, including myself, I don't want to put words in your mouth, but I would assume for you, when we were young, first starting off investing, it was a great entry-level tool back in the day for us to have a professional manager manage our money, to be able to have diversification, right? Because we were only going to be saving a little bit of money from each paycheck. So there was no way to accomplish diversification without mutual funds. It was regulated. We could compare against one another. There was a lot of good reasons for actively managed, well, let's just say mutual funds, but actively managed mutual funds back in the day when we were entry-level investors. And now that we have 100 years of history and we can break it out in different segments, it doesn't matter how you try to cherry pick time frames. If you take any extended period of time, 10 plus years of time, the actively managed mutual funds are going to lose. The S&P 500 is going to way outperform it. Here's some numbers. Ready? Over the last 30 years, the S&P 500 is performing at about a little over 10% over the last 30 years. Actively managed mutual funds, 3.98%. 3.98% over the last 30 years. Horrific. And if someone tries to, oh no, but I read something that said 6%. Okay. Woo, 6% versus over 10%. I don't care how you slice it. It's poor performance and you're paying a lot more fees to have it. It's terrible performance. 40% fail every 10 years. 40% of mutual funds fail within 10 years. 40% failure rate within 10 years. And if you come to the class, we'll explain why that happens and why it's so prevalent and why it will shock you. Some of it is because of the regulations they have to follow. And when the markets change and conditions change, particularly on the fixed income side, they don't have the flexibility that they need to be able to pivot. So they just let it sort of dwindle, die slowly, and they create new funds that are more relevant for today's time. And why would they kill it? Because they're generating fees off of it. Why would they ever abandon it until there's not enough money in it where people are investing in it to manage it? So they just kind of let it linger, and about 40% will fail in 10 years. Paul, there's so many statistical things that, why don't you share a few? Because the performance is horrendous. I just can't believe they allow it still.
I mean, it is. I mean, I think while this show isn't about do-it-yourselfers, so I don't want to go off here, but I do want to make a comment that, you just throw out a lot of really bad data, right? I mean, you basically said that, at the end of the day, active management, just in general, active management fails compared to passive investing. Just whether it's a mutual fund or you have an advisor who's buying and selling individual stocks. Active management doesn't work. To me, the most humbling piece of this is we're talking about money managers who have millions and billions of dollars at their hands. They have all the research tools. They have all of the analytics. They have all the data. They have teams of people. And you're telling us that they fail way more than they succeed. How is it that John Doe, who's listening, who's doing it himself or herself, especially as they get ready for retirement, how do they think they're going to be able to do it if you have these professionals, and this is what they get paid for, fail more than they win? I mean, it's rhetorical. It just doesn't make sense.
They can't, Paul. So I don't know how someone could think that they're going to beat the professionals. I mean, Cramer has underperformed the S&P 500. Jim Cramer has underperformed the S&P 500 by greater than 100% since 2000.
Who's Jim Cramer, Kirk?
Yeah, you all know. I shouldn't. Maybe we should have him. Maybe we should edit that out because probably not. Shouldn't be saying his name, but. Whatever. The point is, these professionals, they have resources. They have access to people. Here's what I know what you do. First, you look at net expense ratio, and we're going to teach you that's wrong in the next segment. Then you're going to look at recent performance, which is really bad because there's something called reversion to the mean. When something does really well, it gets really expensive, and then it will correct. And then you go to Morningstar, which they've already done studies. Google the Morningstar study. Wall Street Journal and Vanguard did a study, I think it was in 2016, that determined there was no correlation between the number of stars and near-term performance. In fact, they found that the higher the number of the stars, the worse the near-term performance. So you guys, it's crazy. None of these managers can stay in the top quartile for 5 consecutive years. Stop. We're going to talk about some solutions, some better alternatives, not even alternatives, better options for investing, especially if you're going to do it yourself or as you age. But mutual funds are dying. Everyone knows they're dying. They're going to be dead within 5 to 10 years, where exchange traded funds will own a much greater market share of people's finances than mutual funds. So again, come to a class. You're going to learn so much at this 8-hour. It's like a master's level course. We're going to teach you how to spend more. We teach you how to pay less taxes. We teach you to have more freedom, retire earlier, and most importantly, how do you choose the right team? That's what we're going to teach you, is how do you know specifically the right teams to help you? So go to 1-800, if you'd like to register, go to retirementplanningedu.org. That's retirementplanningedu.org. To find our latest white papers and webinars, go to retirementplanningedu.org. That's retirementplanningedu.org. And remember to subscribe or follow wherever you listen to your podcasts. And now back to the show.
Okay, we've covered the bad, the worst. We're here for the ugly, and that's fees, Kirk and Paul.
We are. This one's a little disgusting to me. Well, they're all disgusting. I don't know why. I mean, but the fees.
We could have had this show, the ugly, and the ugly, and been fine.
Yeah, I think you're right. Look, actively managed mutual funds, the general consumer is so confused. Everything isn't being disclosed as it should be disclosed, no matter what. You got to ask the regulators. I don't understand why they don't disclose all the fees. There's so many non-disclosed hidden fees. So net expense ratio isn't everything, folks. So I know that's how many of you are choosing in your 401ks and your 4s what to invest in, or when you're choosing mutual funds, or when someone's selling you a mutual fund. The expense ratio is not all the fees. Here's the average cost. There's a lot of hidden fees. And I know some of you are going to say, no, but I've got institutional shares. I just did an analysis on a mutual fund with an institutional share where they were paying 4.5% for a bond fund. A bond fund. Because they were being bought and sold so many times in a given year. So here's the deal. The average cost of an actively managed mutual fund, depending on which study and who you want to believe, is somewhere between 1.5% and 2.5%. That is what you're paying just for to own the mutual fund, 1.5% to 2.5%. That doesn't include the advisor fee, which I don't know why anyone would go to an advisor to have them go hire someone else to manage the money and pay the 1.5% to 2.5% for the mutual fund and then pay another 1% to the advisor. all of you listening, this is why you got to come to the class. You should only pay 1% or less, and that should include the investments, expense ratios, plans, tax projections, forecasting, mapping out your income for 30 years. This is crazy. These fees are insane. This is why they're slowly fading away. As the consumer gets more knowledgeable and educated, that's why exchange-traded funds are replacing mutual funds, actively managed mutual funds. Your index funds are replacing the actively managed mutual funds. The fees are enormous, Paul. They're just, Paul, go ahead. Talk about a few of the other ones.
Well, actually, so I mean, there's just a lot of fees, right? There's management fees, what we call 12B1 fees. There's loads, redemption fees. There's transaction fees. I mean, every time that mutual fund manager is buying and selling, there are fees, and none of those are disclosed. So, I mean, there's a lot of fees. I think you've done a good job sort of giving the sense of how big it is. I think the huge disconnect is that most advisors don't know these. And I harken back, Kirk, you probably do not remember this, a time when we met somebody in class and they had an advisor and they asked us to sit with that advisor because we had a section in the class about these fees, and they were like, there's no way we have these fees. And I'll never forget sitting in a room with this advisor and asking this person who came to class, their advisor, how much fees are they paying? And they quoted saying they're paying about 1%. And then we projected on the board, because we did this analysis for them, it was like 3 to 4%. The advisor had no idea.
Paul, that advisor, Paul, big, prominent advisor in the Ann Arbor
I'm not going to get, yes.
$billion dollar plus company.
Yes, I had no idea.
No clue.
They were. I was embarrassed for them a little bit because they looked up, and this was data. We didn't make it up. No idea that their client was being charged 3%. Had no idea. So you said this earlier. We're not saying all advisors are bad. The reality is most advisors are not educated. They don't know this information.
It's sad. I mean, a lot of people in this business are salespeople. They are not technically skilled. They don't really understand the mechanics. They don't know what's going to really drive performance. They're really skilled salespeople that go through sales training, right? And so why, if someone's teaching you to do something, are they going to disclose the bad things of something, right? So they don't even know. And this person was the advisor was a seasoned person that's been in the business for 30 plus years. I mean, it was embarrassing for that person. But setting that aside, I mean, look, one giveaway, folks, is you can look up your turnover ratios. Turnover ratio means how many times in a given year they're going to buy and sell a particular holding in that fund. So call it 50% turnover ratio means they've bought and sold half of everything in that mutual fund one time. And every time there's a turnover, there can be a transaction fee, or there can be a commission, there could be a spread if there's a bond, there's taxable events if it's in a taxable account. This is how and why they cost between 1.5% and 2.5%. So one of the areas that you can go to do some research is look at turnover ratio. Go ahead and look at your bond funds right now and see your turnover ratios of 100, 200. I mentioned 1,500%. I mean, literally, that means 300 to 500 different holdings were bought and sold 15 times in a 1 year period. That's why they were paying 4.5% for their institutional share, their admiral share. I mean, their special share class that is discounted. There's so many hidden fees. Please hear us. You need to look, that's the purpose of the class, right? The class is offered by a national charity. They have taught over 10,000 people around this country. Probably a larger number, and hundreds of thousands of people consuming webinars, white papers, radio shows, podcasts, TV shows by the charity. It's an 8-hour class taught in 2 evenings or 1 full Saturday. It's taught in most universities and colleges in your area. All you have to do is make a $29 donation to charity, and we're going to teach you how to be able to retire earlier, spend more money in retirement, pay less taxes in retirement. I'm telling you, $1 to $20 million people, hear us. I know you're really smart and sophisticated. You don't know this. And your advisors don't do this. So that's the other thing we're going to teach you. How do you choose an advisor? What specific questions ask? What should a retirement plan really look like and have in it? So you have the ability to choose the right advisor. Register for one of these classes. Go to retirementplanningedu.org. That's retirementplanningedu.org. Thanks for listening to the Retirement Education Hour. Be sure to follow or subscribe when listening on Spotify, Apple Podcasts, or wherever you listen to your podcasts. And now, back to the show.
Now, we've been talking today about the bad, the worst, and the ugly as it relates to actively managed mutual funds. But today, in this part of the program, Kirk and Paul, let's get optimistic. Let's talk about options on how to fix this. What are the solutions here?
So we would argue the preferred options. In fact, before we go to the preferred options, Paul, I think it's important because what you invest in, it shouldn't be based upon someone's opinions, feelings, thoughts, and it's backwards, right? When you're young, it was really easy. It really was. And unfortunately, most people didn't take this approach. If they had, it'd have been much better off. Like, for example, if you just had stuck $1 million in the S&P 500 20 years ago, today it would be worth $6.5 million. That's it. And none of you beat that. No one would have done better than that. No, I have not yet to meet 10,000 people we've taught. I've challenged 10,000 people to prove that they've beaten that. No one's come close. And they don't. They don't come close for a lot of reasons. Emotions, feelings, all kinds of nonsense. Trying to pick things. It's super simple when you're young. But when you retire, it gets more complicated. And it is not about your feelings, your risk, your anxiety. It shouldn't be about any of those things. It shouldn't be about your advisor's feelings or philosophies or strategies. What you invest in is driven by your plan. Your plan that someone needs to design, mapping out 25, 30 years of your retirement year by year. Where are you going to take money from? Where do you take money from when there is a major event? Because you're going to have 4 to 7 major events throughout your retirement. So how can I take the same amount of money without changing my lifestyle or worrying or fearful when we have those events? Meaning an income plan with pivot accounts so that when we have these different events occurring, I can pivot somewhere else to take my money. So I'm not changing my investments based upon market conditions. I'm changing just where I take my income from based upon market conditions. That will drive the best real return. That will drive the best income output for you. And it's all about income, folks. It's about income. That's what you want, right? And so what is the best options for you? Well, I will tell you, we'll give you some. We'll give you a few. But it's based upon what do you need to give you what you want and when do you want it in retirement. And that's so what do I need to give me what I want is going to drive my risk, going to drive what I invest in. When do I want it? It's going to drive what my risk, what I want, and how to invest it. And then having some pivot accounts so that when we have these major market events, we have some place to go to take income from, and we can suspend taking from our aggressive investments instead of taking money out of those when the markets are down. So it is much more nuanced. The tools that you should use, and I think these are just tools, Paul, and you can say some of them, but I'm going to really quickly spit off a few. Exchange traded funds, passive, not active. 75% of ETFs are passive. You're going to see an uptick in actively managed ETFs. Stay away from actively managed ETFs. Passive ETFs. Passive index funds, not actively managed mutual funds, but passive index funds. Most every one of you have that in your 4s. Sometimes insurance can be part of the solution for a pivot account. Individual bonds, individual muni bonds, corporate bonds, treasury bonds by a professional who build and manage those portfolios. So you have pivot accounts during market volatility. We teach this in the class, but the plan will drive what you should own. Those are some of the tools that we would think you should use, but not ever actively managed mutual fund as a tool, Paul.
Yeah, you really got to the heart of it. I think if I could just add that if everything you just said, all the various tools that you just listed, for the most part, none of them are about picking stocks. Most of it's passive. Most of it is not active management, not someone buying and selling and buying and selling and buying and selling. And there's a reason for that, right? Because buying and selling costs to do that. And 9 times out of 10, you're going to get it wrong. The problem is it gets to the heart of the value proposition that most advisors offer, right? It's their secret sauce. They know they have some special algorithm to know how to invest your money. It is not, there's no secret sauce, right? As you said, Kirk, said it well. It's the plan that drives this. Depending on when you need income and how much income you need, is going to drive what to invest in and how much risk you take. It's not how do you feel. It's not your personality. It's not a secret sauce. It's the income plan.
Paul, the Day Traders Hall of Fame is empty for a reason. It doesn't exist. And there's a Financial Service Hall of Fame. Day Traders Hall of Fame is empty for a reason. What is going to drive performance and success isn't people who think they can time the markets and adjust your investments accordingly. It's being able to have accounts that you can pivot to when we have bad market events, because we're going to have them, just to take our income from and leave the other accounts alone. And don't rebalance when the markets are down. If this sounds weird to you, you've not heard this before, you need to attend the 8-hour class, because we're going to give you the tools to be able to go out and find the right teams to help you, because you will have the knowledge and education and proven data that what will drive success in retirement. We're going to show you what retirement plans look like and what you should be looking for. Okay, so attend one of our 8-hour courses that are taught at major universities and colleges in your areas. We also stream them for people all over the country so they can participate. If you'd like to register, go to retirementplanningedu.org. That is retirementplanningedu.org.
Retirement Education Foundation is a fiscally sponsored program of United Charitable, a registered 501c3 public charity. Investing involves risk, including the potential loss of principal. Any insurance discussed in this show is backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Retirement Education Foundation is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Retirement Education Foundation. This radio show is paid for by the Retirement Education Foundation.